Welcome to the Money Runner. I'm David Nelson, your host. In this podcast, we're going to be talking about the closeout of the first half, the end of the second quarter, and what the setup for the third quarter looks like as we kick off the week. Let me just turn back the clock a couple of days. Let's go back to Friday's trading. Kind of interesting day. Usually on any quarter end, you get a fair amount of chaotic trading, a lot of position squaring, a lot of window dressing. Some firms taking profits, some looking to get into new positions, all around shifting of the portfolio. However, this day was a little different because this Friday, in addition to being the last trading day of the month, it was also the day after what was a monumental debate on Thursday night. And I don't think there's a living American who was watching that debate that didn't come away concerned, regardless of which side of the aisle you live on. It was pretty clear that President Biden it was beyond struggling. It was very clear that he was having lapses, and I don't think anyone believes it was just a medical episode. This has been going on for quite some time, for the better part of a year. People have been questioning his health, his stamina, and his mental acuity, and it really showed up in colors on Thursday night. There's no denying that. Even the president's strongest supporters have admitted that. What's more telling is that the American public is rightly angry because a lot of the handlers, the people closest to the president, from Chuck Schumer to Nancy Pelosi to people within the White House, campaign staffers, and his family have been telling us, off the cameras, he's as sharp as a tack. They can't keep up with him. Obviously, all nonsense. There's a lot of people there that seem to want to remain in power rather than let this gentleman, after 50 years of service, march off into the sunset. This should have never happened, but it did. And as a result, the trading reflected that on Friday. So let's talk about that trading. I think beyond the position squaring that I just mentioned, what I did find interesting is that the market was clearly pricing in better chances for Trump. So I don't want to even get into which side of the aisle you live on, whether you're for Biden, you're for Trump, or you'll vote for anybody that isn't Trump, whatever it is. Let's talk about the market and what the market was saying. And what the market was clearly saying was that Trump has a better chance of winning this election, and certain stocks were going up, certain stocks were going down. There were a lot of trades going on that day. The one I want to focus on the most was really managed care. It was very clear that they had a bid throughout the day. United Healthcare was one I focused on pretty intently during the day, and I also noticed that not only was United Healthcare up, I thought it was interesting that most of the hospital stocks were down. And I started to think about it. There's no love lost between managed care companies and the Biden administration. The Biden administration has come out hard against managed care, especially in terms of pricing. And if they're going to have a better year from a Trump presidency, maybe a deregulatory environment, in their mind, maybe they can save a little money. And any money that they save is likely money out of the pocket of a hospital stock, because who pays the bills? The managed care companies. So that trade made sense. So United Healthcare had a bid for most of the day. What I found striking was in the last couple of minutes, just before the close, I had alarm bells going off all over my screen, and suddenly United Healthcare had spiked dramatically at the end of the day. And I was trying to figure that out. I really couldn't come up with an answer. I just thought either some sloppy trading, somebody who wasn't price sensitive that had to get into the name. And I didn't find out until later that evening when I went to CNBC studios in Englewood Cliffs, New Jersey. I had an interview set up with Brian Sullivan, anchor of course, of CNBC's Last Call, along with the other guest on the program was going to be, I believe it's Ben Evans of FedWatch Advisors. I got there into the studio. In the green room was Dan Ives. Most people know Dan, but Brian, stuck his head in just after six o'clock. The show was set for 7. They were a little early, and he stuck his head in and said the New York Times just dropped an op-ed by Tom Friedman, and in that op-ed, Tom Friedman was saying that President Biden should step down as the candidate for the Democratic Party for this election. And he listed his reasons why, some of the ones that I just told you. And this is, of course, a huge supporter of this president, even a friend of the president. And it's coming from a newspaper that has a fair amount of swing within the electorate as a whole, but also they've been very much a supporter, and some would even call them left-leaning. So put that aside. It was kind of dramatic that they did it. Then it all came together for me. It suddenly made sense. In the last few minutes of trading, uh, that op-ed had to have leaked out. And since it was such a monumental op-ed, followed by another op-ed from the overall board at the New York Times, it probably caused some pretty heavy buying in the name. So that leaked out there. Just wanted to throw that out there. We'll see if there's any follow through with that on Monday's trading. Let me turn to what Q3, what the setup is like. We've obviously had a very, very strong first half. But of course, as we know, and as we penned in many articles in the past, a lot of the performance in this market has largely been driven by a handful of names. As a matter of fact, there are 5 names. I'll put them on a chart maybe for this. I don't have the names right in front of me right now, but there are 5 names that have really driven a tremendous part of not just the performance of the market, but it's also a big part of the earnings of the market. And we pointed out in a previous post that after the Q1 reports, those 5 names saw their estimates go up about 38% for the rest of the year. And the other 495 stocks in the S&P 500, in aggregate, saw their estimates cut. That doesn't mean there aren't other companies out there that are doing phenomenally well, and you can find those if you do the digging and you do your homework. But in aggregate, the estimates were cut. So that's kind of telling. So that shouldn't be a surprise that we got the performance. So what's interesting here is kind of the bulge bracket research that I'm seeing out there, because it's forcing me to think about what the trade is like going into Q3 in just a few weeks. And this is where it gets kind of interesting. I had access to 2 reports, kind of diametrically opposed. First is from Marko Kolanovic, the chief strategist, or one of the strategists from JP Morgan. No surprise here. Marko is pretty bearish. He's been bearish for a few years here, and he's largely been wrong. But that doesn't mean he's always going to be wrong. Let's look at David Constan's analysis and why he says the following. On average, high valuation growth stocks face asymmetric downside. Right, and he's referring to a growth stock as 15% sales growth, right? And what he's saying basically is, if these companies, if they beat consensus, they're looking at maybe 11% on the upside. If they just meet consensus, potentially 8 percentage points on the downside, and if they miss, it could get pretty ugly, down 32%. That's what he's referring to. These stocks have run pretty hard. And when you've had this kind of excess return for this period of time, and now analysts have caught up a lot with the estimate revisions, the potential for to beat is even harder. All right. And what he's saying is, at these valuation levels and this level of excess return, that if you miss, it could get pretty ugly. That's what he's pointing to. So what I'm doing right now is I'm scrubbing every single company I own, and I'm starting to look at what is the potential for a miss. I've identified a few. All right, one that I'm going to be selling probably right off the bat at the start of the week is going to be Progressive. It's had a decent run. I'm not up a lot in it, but I've seen estimates cut for the year by as much as 18%. So I'm going to be exiting this position in here. I went and looked. One of the ones I'm the most concerned with, but I still don't have a trigger to reduce yet, and that is Alphabet. A lot of concern about Alphabet and its position in AI. People are wondering, are they going to really be a consistent player? Because the whole idea that search could be disrupted, remember, they get paid for every click. And if AI could make search more efficient and you get less clicks, that means less advertising revenue. It's a concern. Maybe it was part of the reason that Rosenblatt downgraded shares on Friday. Stock was only modestly weak that day, but it's an overweight position for me right now. I'm a little bit above its market weight, somewhere around 4.25%. That's about where I am. I may have to take that to 3.5 or maybe even 3. I got to at least consider that at this point. I'm going to have to take a look at Microsoft. I haven't looked at that one in a while. I've already reduced NVIDIA a couple of times. Probably sold NVIDIA maybe 4 times over the last year. It's a modest underweight for me. I think it's probably about over 6% in the S&P 500. I'm probably somewhere around 5 at this point. So I still have a pretty hefty position, but it's not a market weight. I'm going to have to take a look at Meta and Apple. I've already taken a look at. I'm comfortable with Apple. Apple is being treated more as a turnaround stock at this point, just about to go into an increased device cycle. Their last announcement and what they're going to be doing with AI is going to be demand really their customer base if they want to use these new features in AI. It's going to demand that they get new phones for anything older than an iPhone 15, their last model. I have an iPhone 14, so I'm likely to get a 16, and I know a lot of other people will as well. So I'm comfortable with where Apple is. I'm going to have to scrub all the rest of them. Fortunately for me, I've got some time here. Because the first companies that will be reporting of any size, you got Delta, I think, at the end of this coming week, but really it gets real the following week, the following Friday. So a week from this Friday, we're going to get J.P. Morgan and some of the other banks, and that's really, to me, the official start of earnings season. Let me turn back to really, what's going to drive equity markets for the next couple of weeks. I think the election is going to be front and center. You're not even going to be able to get it off the airways. If President Biden is going to continue to run, then what we're going to need to see for him to remain viable, he's going to have to do lots of interviews. He's going to have to take every podcast. He's going to have to get on every program and show that he can, without a teleprompter, have a conversation with an interviewer. And then if something else is going to happen, it behooves the Democratic Party to get started on it right now. Short of that, we're going to have to answer the following question. If President Biden is not fit to run, is he fit to serve? I think questions of the 25th Amendment are going to start to come up because this is what the 25th Amendment was written for. The potential incapacitation of a president. And a lot of people in America right now are wondering if this president is capable of being commander-in-chief. Certainly, he has moments of clarity, and certainly there are periods of time where he does seem like commander-in-chief, but can there be any lapses in that when you're talking about such an important position? I think most Americans would say, no, there cannot be any lapses. So who's going to be leading the country? Who is likely to step up? And I think what the Democratic Party is going to have to shape in how they what's the word I'm looking for? And how they tell this story is most Americans understand that if they're voting for Joe Biden, they're likely really voting for Vice President Harris because she's likely going to be taking up the reins sometime during this administration. Either the president will step down or perhaps something worse. But they're going to have to get her out there, and they're going to have to get the nation comfortable with her as the president of the United States because she doesn't poll well. She actually polls less than Joe Biden. So let's see how that plays out. But all of this will be, in the internal voting mechanism of the market and what it says about this situation, and you'll see it in individual stocks, you'll see it in individual asset classes, you will see it in bonds, you will see it in commodities, you will see it in gold, you'll even see it in Bitcoin. All of those mechanisms in one way or another will be votes about what's happening with the election cycle. That's it for today. If you like the podcast, please visit me at my substack.com site, dcnelson123 at substack.com. A lot of charts, a lot of extras there. And of course, my YouTube site, The Money Runner on YouTube. Like I said, that's it for this week. I'll be back as soon as I can. Thanks for joining. I'm David Nelson, and this is The Money Runner.